welcome everyone to our webinar, our third and last for the year. It's a pleasure to be hosting the session again with our members, and thank you for all those who are able to make it. We have a very interesting session for you today, covering just a macro overview of global markets and also an update on the AI fund, where most of you are currently invested. So I believe I've met most of you already, but for those of you that I haven't met before, my name is Anne, and I am the Senior Wealth Advisor here from Sanlam Private Wealth, and I am based in Mauritius. I usually speak to all of you, to most of you on a very regular basis, sometimes on a weekly basis, but it's a pleasure for me to have you on our session today. So for today's session, we have two remarkable speakers with us today. Thank you, Alvain and Jorge, for your time this afternoon. So we'll start off with Alvain, who will give us a global overview of markets year to date and some expectation for the year to come as well. Alvain is Director of Investment for Sanlam Private Wealth, has been since 2007, and he has over 25 years of experience in the industry, managing institutional and unit trust portfolio throughout his career. And Alvain also currently leads and chairs Sanlam Private Wealth's formal investment committee. So thank you, Alvain, for being here today. I'll hand it over straight to you for the first part of the presentation, and then we'll speak to Jorge after for the update on the AI portfolio.
Good afternoon, Anne, and thank you very much for the kind introduction. Ladies and gentlemen, welcome to the presentation. I'm going to share my screen, if you can just bear with me. And I trust that you can see the full slide on your side now.
We can see the slides, but if you want to make it bigger, you can as well.
Well, this is
I think,
my
Alvin,
side.
you need to switch the screens on your side.
That I am not sure how to do that. I'm only an investment analyst.
But we can see it fine.
Can you see it fine? Okay. Ladies and gentlemen, once again, thank you very much for spending some time with us this afternoon. You know, as Anne said, I joined Sanlam Private Wealth in the capacity of Chief Investment Officer or Director of Investments in 2007. So this will be the 15th year that I will do a review of what has happened on a year-to-date basis in December, and then give a preview of what is going to happen what we expect is going to happen over the next 12 months. Now, if I look at my track record over the last 15 years, we've often been surprised with how the macro environment and markets have unfolded in the following 12 months. But I can promise you, whatever I say about the past, that is entirely the truth. So hopefully in 12 months' time, when you look back, we will see that maybe some of the thoughts that we shared in terms of the future will come through over the next 12 months. If we look back, I think it is very important that we just highlight a few of the major macro trends that played out during the year. And I think, you know, for a person who's not really involved in the market, the one thing that stood out this year was it was certainly a year where there was massive geopolitical uncertainty. We know about the war between Russia and Ukraine, which started in March, and it is still continuing, and massive damage being caused to the Ukraine territory. But from a market perspective, I think the most important part of the impact of the war was, firstly, it created a lot of uncertainty from a global perspective. And secondly, it also had a direct impact on the markets in the form of the supply of commodities into world markets, and oil in particular. And what we have seen is that the oil price, which traded roughly at about $80 at the time, went up to about $120, $127 a few months later. And it was also one of the triggers that pushed inflation globally to higher levels. And of course, that had enormous amount of knock-on effects on financial markets. So that is the one side of it. Then what we've also seen, of course, is part of this geopolitical uncertainty theme was that about 2 weeks ago, the Chinese had their 20th National Congress of the Communist Party, and it was very clear that the Western world in particular didn't really know how to interpret some of the thoughts and the stances that was clearly displayed at that conference towards the West from a political perspective, but also from an economic perspective. And again, that also created a lot of uncertainty. And then, of course, we had the change in the monarchy. And then I think the Brits, they scored a record, probably beat the Italians from that perspective. But we had 3 prime ministers in 2 months' time in the UK. So those were the things that kept us entertained. But in the end, whether we like it or not, it was all about financial markets. What we do is we try to manage money for other people, and we try and do it in a very responsible way by trying to understand what happens in the macro world and then ultimately pull it through into the financial world. So I went back to the presentation that I did in February. To some of you might have been present there. And I just thought I wanted to take 2 slides out of the pack that I showed at the time to highlight the 2, to my mind, most important points that we highlighted at the time. The first point that we made in February this year was that we said that policy interest rates across the world were incredibly low, and they were unsustainably low. Why did we say that? If you look at this particular slide, and this simply shows you the Fed funds rate, and that is the policy rate for interest rates in the US, you can see that that was virtually 0. So the cost of money was 0. So all the assets that priced off the cost of money, equities, property, any risky asset, priced off a very low price, and therefore those prices were inflated. So the risk was, should the price of money go up, that other financial assets, as a result of that, the prices would come under pressure. So what would make these policy rates go up? The second point that we've highlighted was the fact that we said that if you look at inflation rate across the world, and in this case, I simply show you the inflation rate in the US, was undeniably starting to become a problem. And many people said at the time that it was only a supply side problem. In other words, there was not enough goods to satisfy demand. And as a result of the fact that there was not enough goods, as a result of supply chain issues, inflation would not be a sustainable problem. Our analysis at the time indicated that there was, in fact, quite strong demand coming through in the US as an example, but certainly in other parts of the world. And when this went up, you just know that central banks would kick in. And what is the role of central banks? Central banks, the primary role is to protect the buying power of their particular currency. In order to do that, you need to keep inflation under control. And because inflation kicked up, of course, we've seen the start of the upward interest rate cycle. And the net result was that those assets that were quite expensive at the time, equities, government bonds, came under severe pressure, and those prices fell significantly. And in the first 6 months, to give you an indication, the US market, as measured by the broader index, the S&P 500, lost about 20% of its value. And the very inflated or expensive NASDAQ index, which was the index where most of these high-flying information technology shares were listed, that index came under more pressure and in fact lost about 30% of its value in the first 6 months of the year. If you look at the world as a whole, and these numbers are from the beginning of January to the end of November, you can see that global equities as an asset class lost about 14.5% of its value in dollar terms. The NASDAQ, which was very expensive and was highlighted by us as being one of the expensive markets in the world. And of course, as a result of that, a lot of risk associated with that market, that dropped by about 26%. Global bonds, 16.7%. And I think, Mark and Anne, this deserves a comment, because what people normally do when you build multi-asset portfolios, they have a combination of equities and bonds in the portfolio, because the traditional thinking is that these two asset classes are what we call uncorrelated. In other words, when the one price goes in one direction, the other asset class price goes into another direction. So it provides a better risk-adjusted portfolio if you combine these two asset classes. Unfortunately, 2022 was not the case. Both those asset classes came under severe pressure, and you can see that. And then property didn't escape it. And really, one of the few areas where you could hide was in cash. In dollar terms, you got 1.5%, and commodities, and by the way, oil price in particular was in positive territory for this year. So, you know, many people would describe this year from an investment performance perspective as a horrible year. And the reason for that was there was really nowhere to hide in any of these asset classes that normally provide you the building blocks to build wealth over the longer term. But certainly this was not the case. So it was a very tough year for clients. It was a tough year for asset managers. At least in our case, you know, we did warn that those asset classes, both bonds and equities, were expensive. So we had, when we ran multi-asset portfolios, we had more cash in our portfolios for that reason. And of course, it played out. But, you know, for longer term portfolios can never have 0% in equities or 0% in bonds. So it would have been quite a cumbersome year for many investors. The question is, and perhaps that is the more important one is, you know, what do we expect? How should 2023 unfold? And, you know, there are many themes that can evolve in 2023. You know, a lot of people talk about the house price bubble in the US and elsewhere, in London in particular. You know, people talk about the risk of global trade that can come under pressure. People talk about cyber complacency. And so I can list a lot of themes that are likely to play out within financial markets over 2023. But I think for today, I would like to focus on 5 things because I've only got 15 minutes, and I would like to give you a very succinct view on those variables, because I think these variables that I've highlighted on this slide, again, will determine how investment portfolios will perform for clients. Now, let's start with interest rates, because I think it was the dominant factor of 2022. We've had a significant increase in interest rates across the world. You look at the US, you look at Europe, UK, even in the emerging world, we've certainly seen that interest rates have picked up significantly. I think the interest rate cycle is well advanced, and it is likely to peak in the first half of 2023. Because by that time, it should be quite clear that the inflation rate has peaked and that the inflation rate is starting to come off. What is very important, though, is the momentum of that inflation rate coming off. So if the momentum of the slowdown in inflation is disappointing, one might see that interest rates might be higher for longer. And of course, that brings the whole issue of economic growth, or will we or won't we see a recession in 2023? And then finally, you know, geopolitical uncertainty. We are not geopolitical analysts or war analysts, so we can't predict how the outcome of the war will be for 2023. But the one thing that we can say is that a lot of the geopolitical uncertainty that was on the forefront in 2022 will remain part of our life into 2023, because these are long-term issues that the different constituents need to sort out, and it's not going to happen overnight. So that uncertainty will remain with us during 2023. So what is our view against that background? What is our view on equities? The first thing is that we can say is that equities no longer trades at ultra high level or bubble territory in terms of valuation. That is not the case. So with the sell-off in equities, at least we know that equity prices are cheaper, And if your starting point is lower, the prospective return should be better. But with that, and I'll explain that later on, you should also expect continued volatility. In other words, profound changes in short bull and bear markets, or ups and downs in equity prices during 2023. And I'll explain why I say that. And the same with bonds. Last year, we were very concerned about bonds, certainly from a valuation perspective. At least they are no longer that expensive. And should economic growth slow into and go into negative territory, in other words, we talk about a recession by mid-year in the US and perhaps even earlier in Europe, what we have found, history has taught us, is that during a recession, bonds do act as a safe haven for investment portfolios. And I would just like to give a bit more color on one or two of these things. The first thing is, let's just talk about interest rates. So hopefully you can see this chart, and the red line is the important line. The red line is what we call the expectation of the Fed funds rate in December 2023. So in December 21, the market thought that the Fed funds rate at the end of 2023 will be at 1.3%. You can see the current expectation is that the Fed funds rate is likely to be between 4.5% and 5%. So that is the first point. So that is a massive change in expectations that has happened. Of course, a lot of that is as a result of high inflation and the guidance that the Fed has given us. Now, the interesting thing is, what I've done here, I've inverted the performance of the S&P 500 and the NASDAQ. In other words, when the blue and the black line goes up, it means that these, and I've indexed it to 100, it means that these prices are falling. And you can see they fell until about June, and then in essence went sideways. Why did they go sideways? The market started to become more comfortable that the rate of the Fed funds rate at the end of 2023, they are comfortable that this level is probably going to be the ballpark number for that level. So there are less interest rate fears in the market. So what will happen if that red line changes, or the expectations on interest rate changes? Then I think equity prices will respond quite aggressively, like we have seen here. So if it suddenly dawns in the market that maybe the red line or interest rates might be lower, you can also expect that these two lines, the NASDAQ and the S&P 500, can appreciate in value at the time. So that is the very important point. You can see how the market quite accurately calibrated around changes in interest rate expectations. So that is the first thing. Secondly, we can't do a presentation without talking about valuation. And for us, we are longer term investors. And despite what I say over the next 12 months, we think about the next cycle, which is normally in the next 5 or 6 years. And what we can see is, if you look at this particular blue line, that just shows you the trend of the S&P 500. So those are US equities, and the dotted line shows you the longer term trend. And what you can see is that from very elevated levels, the market came back and it's now trading right in line with its longer term trend. Now, when you normally go into recession, like we've had here in 2009, you will see that the market will fall through the longer term trend, depending on your starting point, of course, and then it recovers. So the market is certainly cheaper, but it is not as dirt cheap as it was back in 2020 or back in 2009. So when we talk to clients, we don't want to overpromise in terms of equity performance, but the one thing that we can say is the market is decently calibrated regarding or relative to the interest rate expectations. But should you go into recession, what normally happens, the market normally shows the last leg of a bear market into recession. Our view is that we might enter into a soft recession towards mid-year. So we don't think it's the end of the problems, but at least the market is much cheaper, and therefore the prospective returns should look much better compared to a year ago. I want to conclude by just sharing my view on volatility or big changes up and down in equity prices. When you look at how portfolios are positioned across the world, not only in South Africa, but we talk about across the world, it is quite clear that the risk that we spoke about is fully appreciated or largely appreciated by most fund managers. So most fund managers in their portfolios carry quite a low exposure to equities at the moment. So should you get any good news, and things can change overnight, as you have seen this year, should you get any good news, there is a tendency, and I will go back to that previous slide, there is a tendency for markets to respond quite quickly. Just look at this blue line. From an index level of 80 in October, the market appreciated to index level of 90. So there was more than a 10% move in less than a month, simply because people started to think rationally about interest rates. And it's not only the traditional fund managers that are likely to buy into equity markets. There are a lot of day traders, ETFs, a lot of hedge funds that are more shorter term orientated. Most of them don't have a big position in equities. And if the news flow changes, there's the likelihood that they can change their portfolios aggressively overnight, and you get these big movements in the equity prices. That is on the positive side. Of course, when the news flow is negative, you would think that the response would also be negative. But because people are already positioned for a lot of bad news, there's not a lot that they can sell from these positions. So we think volatility will be with us. For longer term investors, the prospects look much better than a year ago, but we certainly can't promise the sun and the moon and the earth. There's still too much risk around, and the market is only rational and not irrationally cheap, which is normally the levels that you need if you want massive bounces in any asset price. So Anne and Mark and ladies and gentlemen, we would think that this year, 2023, that will come. From an economic perspective, times might even toughen. But from a financial market perspective, we think that many of these assets have priced in at least high interest rates, maybe not fully priced in a recession, but through the cycle, we think the cycle looks far more healthy compared to a year ago. And we should expect returns that will reward investors for the risk that they take in buying equities or government bonds at this particular time. So that in a nutshell, our view, and I hope that it turns out the way that we've explained it. And I also hope that you have a wonderful festive season and a good end to 2022, which was a very tough year for a lot of people. Thank you very much.
Thank you, Alvin. I do have a couple of questions that come through, but I'll come back to you after Jorge's presentation. Jorge, I'll come straight onto you now. Thank you again for your time, for being with us today. You are a frequent presenter to our webinar, so I believe most of our members would recognize a familiar face. So George has over 20 years of investment experience in the private investment sector. We've experience with high net worth individual, retail and corporate clients as well. And he's currently the Vice President at Sanlam Global Investment Solutions. Thank you, George. I'll hand it over to you.
And thank you very much. Appreciate it. Good morning, everyone. And Alvin, thank you so much for those comments and overview for the next year. In terms of, let me just share my screen, and I'll start. Just give me 1 second here. Okay, so in terms of in the next 10-15 minutes, what I'll do is provide an overview on the Sanlam AI ETF portfolios performance, take some of the comments that Alvin mentioned in terms of this year, and some of the concerns that we see across the board from clients, from advisors and so forth. So my prepared remarks, this is just a bit on Sanlam, global company, over 100 years, highly rated, and obviously participation in many, many, many countries. I think Alvin touched on these points, and these are the main concerns. We haven't really had a year like this one in many, many years, where we had heightened volatility. We had a major correction, not only in the equity markets, but also in the fixed income markets. And that was being borne by interest rate policy from the Federal Reserve, the central bank in the United States, which obviously put pressure on bonds, put pressure on fixed income, as Alvin alluded to. So in terms of diversification, where we diversify portfolios, both from a risk perspective and in the traditional asset classes of fixed income and equities, both of those major asset classes had a big correction, and obviously we had underperformance this year. So one of the main concerns, and I think Alvin touched on these points, is interest rates, which he covered very well, U.S. Federal Reserve policy, inflation. I think inflation, again, in our view, is inflation is sort of at some point it'll get under control. The Federal Reserve has been very, very aggressive in raising interest rates, and I think for next year the expectations, as Alvin alluded to, is that interest rates at some point are going to abate as inflation eases. Economic slowdown, I think, what the markets are pricing is, if it is a recession, is there sort of a soft landing, because we see, in terms from a consumption basis, we see the U.S. unemployment rate remains very, very low. And so with low unemployment rate, consumption remains intact. And then the big concern is this inflation concern that we've had this year, and again, it's starting to look like it's starting to turn. So going into next year, after a difficult year, we usually see a bounce back. So we see that we've probably had overcorrection on bonds, on fixed income, on the equity markets, and we usually have a recovery right after that. So in the next few slides, I'll just provide several perspective pieces from a long-term view, in terms of when do markets have a correction, what follows. Again, we're taking history as a proxy, not to indicate that will happen into the next cycle, but again, just to provide guidance in terms of when we do have these pullbacks, what can we expect? The worst thing we can do, I think, is as investors, is we obviously the whole objective is to buy low, sell high, and in many instances the inverse happens, where you buy high and sell low, and you sell really at the point where the markets are falling and investors get concerned, and then we have a recovery like we've had always in the past. In 2020, as Alvin pointed out, in 2020 we had the correction on the onset of the pandemic, and the markets recovered very strongly. We have to go back to the previous to that was 2018, when the Standard & Poor's, the S&P 500, again pulled back about 10%, and then we had a recovery shortly after that. Even going back to 2008, 2009, the great financial crisis, which was very painful for that period, we recovered from that period. So, and then we can go back even to longer history and see when we've had corrections in the past and the recoveries that we've had. So a little bit of perspective on that. So in terms of, just to share some of the information, when we look at pullbacks since the going back 60, 70 years, when the S&P has declined by more than 20%, what follows is a recovery. And as Alvin pointed out, the S&P at mid-year was down 20%. NASDAQ, which are the more technology focused companies and industries, they were down by more than 30%. So looking at a history as a proxy, we see that anytime we've had major pullbacks like we've had this year, what follows is a recovery, is a snapback. So again, not to say that that's going to happen in the next cycle, but if we take the history as a proxy for the last 70 years, that's always been the case. In terms of, we just had midterm elections here in the United States, where last week or a couple of weeks ago, and they elected the new Congress, and the outcome from a U.S. election perspective was sort of divided, where the Republicans won the lower chamber of the House of Representatives, and the Senate now is controlled by the Democrats. When we've had divided governments, where we've had both Democrats and Republicans in both Congress or in the presidency, we usually have better markets. We have, we see that the political parties have to come and compromise on certain things, but without being partisan, whether the view is Republican or Democrat. If we just go back to the midterm election cycles, going back again since 1950, post that election cycle, we've always had positive returns. So again, not to indicate that it's going to happen again, but going back to all the midterm cycles, we've always had positive returns. So it's just another indication of what's to come, especially with the volatility that we've had this year. If we look at inflation, so Alvin alluded to inflation, and we haven't had this inflation in over 40 years. And that's why the Federal Reserve was so aggressive, and it's been so aggressive increasing interest rates. And there's another meeting that's going to happen in December, and it appears that they're going to continue to increase interest rates. But again, the inflation picture looks like it's starting to get under control, it's starting to abate. And so once, if we look at the performance of the S&P 500, of the equity markets, after we've had, after inflation has peaked, and then we have to go back to 4 or 5 inflationary periods back to the 1970s, the mid 70s, 80s, 90s, and what we have today, we could see that again, once inflation gets under control, then the equity markets recover, and you have attractive evaluations like Alvin pointed to. So equities become now attractive based on several metrics on that forefront. So what does that mean for the AI portfolios? So a couple enhancements that we've had since the last call on the AI portfolios. So again, in terms of we have 4 portfolies that are managed by, so we have 4 ETF portfolios that is managed by artificial intelligence. So we have this tool that with artificial intelligence, we have the portfolios that can process a lot of information, a lot of data, to try to determine what's the most probable outcome for the next investment period. For the Sanlam AI ETF portfolios, that investment period is for the next 7 days. So the objective of the solution is to look at the underlying investments, and the underlying investments here, I'll come back to this slide in a second. The underlying investments here are ETFs, which really are invested in broad indices in the fixed income area and in the equity area. And we've enhanced the solution, we've enhanced the investment universe, and we've expanded, and we have new investments that we didn't have 6 months ago or from our prior call that I want to mention. So just on an overview basis, the AI portfolios, what is the objective? The objective is to avoid down market participation, avoid participating in a loss, right? And what we do is we have these indices, right, where the AI solution can allocate and can invest both in the fixed income and the equity area to achieve that primary objective of loss avoidance. When we've had a year like this, when we've had, as Alvin alluded to, when we've had correlations, or whenever, when both fixed income and bonds and equities have fallen, no matter how you allocated, no matter how you invested, you lost money. And so it was difficult to achieve that investment objective of avoiding loss. So what we've done is we've gone back and said, okay, look, what can we do to expand this investment universe, to introduce new investments, so that when we do have these correlations is when we invest, we want things to be uncorrelated. If bonds go up, if the equity markets decrease, bonds increase, and therefore you're able to cushion any volatility, right? To smooth out the investment return. What we want at the end of the day is a smooth investment return. And if we look at the longer term the equity markets always sort of increases, as Elvin it alluded to, it always increases over time, not on a smooth basis. We have these periods of volatility and corrections and so forth. So if you're investing for the medium to long term, you can withstand, we can withstand this volatility. We introduced bonds in there to dampen that volatility. Well, this year it hasn't worked because both asset classes were down. So what we did is we went back and looked at the allocations. So in terms of the allocations for the AI portfolios, we have 4 different portfolios and their risk profile. Their risk profile, we have the AI conservative portfolio, balanced, growth, and dynamic. And in terms of what can they invest in, we can see what they can invest in, what broadly they can invest in, right? So the conservative portfolios mostly in bonds, which obviously are conservative in the long term, and they could have very small equity exposure into the equity markets. And so you can see in terms of what's considered the risk asset are equities. You can see that as you increase in the risk tolerance, right, from conservative to balanced to growth, the equity exposure increases. So the AI portfolios on a weekly basis have to maintain these parameters, have to be invested in the equities between 20 to 60%. In terms of the portfolios trying to achieve rule number 1, which is of capital loss avoidance, these portfolios tend to be conservative in nature. So when we look at the equity allocations, the risk asset allocations, they tend to be, when we have a range of, for example, on the AI balanced portfolio of minimum 20% exposure to maximum 60% exposure, you would think that probably the average would probably fall somewhere maybe in the middle, 40%. But because of this primary rule of avoiding loss, these tend to be very risk adverse. And so when we look at the actual allocations over time, the average allocation since we started these portfolios, it tends to be, less than 30%, for example, for the balanced portfolios, it tends to be like 28%. And so on a balanced portfolio, do we really want, if a balanced portfolio is balanced between bonds and stocks, right, between fixed income and equities? And so having these boundaries, they were overly conservative, right? And if you want a growth portfolio, the minimum was 40% in equities and the highest was 75%. And on average, it was less than 50%. So we've done a couple of changes. The first change is that we've expanded we've modified the range, right? So if we look at the previous allocation to the new allocations, we've expanded the range of what's considered the risk asset or the equity asset. Again, the equity is what obviously builds wealth and performance over time. So the difference, as you can see on the screen, we've increased the equity on each of the portfolios. So on the conservative, balance, and growth, now the minimums are, instead of being 0 on the conservative, now there's a 15% minimum exposure. On the balanced portfolio, instead of having a 20% minimum exposure, it's gone up to 40%. Again, if you want a balanced portfolio, you should have a balance, balance between stocks and bonds. And on the growth portfolio, the minimum equity investment went from 40% to 60%. So increasing the equity exposures, the boundaries. And then we can see how that relates to cash and bonds. And then what we've done as well is we introduced a macro hedge overlay, which in simple terms is introduce other indices, other instruments, other ETFs that historically have had low correlation to both stocks and bonds. So when we do have stocks and bonds sort of falling at the same time, to give the AI solution other instruments, other investments to allocate into, to soften that volatility, to dampen that volatility, to hedge against that, to hedge against when we have these major movements, right? And so I'll go into a second what those movements are. So we've introduced, first change is we've increased the minimum equity allocation. And again, the objective is capital loss avoidance. So we expect that, the equity exposure are going to be sort of on the lower end of the range. If we go back in history, since the AI portfolio started nearly 5 years ago, very few instances where the allocations went to the maximum, went to the 60% or 75%. I think it only happened in 3 weeks out of the last 5 years. So they tend to be more on the conservative side. So first thing is increase the equity. Second thing, we've introduced again another mechanism to reduce volatility or to hedge volatility with this macro view. So these are the new new boundaries for each of the portfolios. And so what we've done is we've expanded the investment universe, and we've introduced 5 new instruments. So we've introduced the QQQ ETF, which is the NASDAQ the index. So again, it's sort of the more tech, more small companies, tends to be more aggressive in nature. So this is more aggressive equity to give it more exposure to this. We've also introduced a more conservative equity ETF, the consumer staples ETF. So these are companies like Johnson & Johnson, McDonald's. So these are very large global companies that are consumer staples, right? And so these companies tend to have lower volatility, right? It's sort of the opposite of the small companies or the tech companies. We've also introduced a gold component. So now the AI solution can invest in gold, right? And this is the physical gold expressed by this ETF. So again, when we've had in the past, when we've had heightened inflation, gold tends to be a good hedge asset, or when there's a risk-off environment, gold tends to be a good risk asset in terms of diversifying. So introducing that component, I think we looked at it and it should be beneficial. And then we rounded it off by adding another bond ETF, the U.S. Aggregate Bond Index. U.S. Aggregate Bond Index basically represents U.S. fixed income, both from U.S. government bonds and U.S. corporate bonds. So again, it's more liquid. And then to sort of round off this macro view, this global hedge macro view, we also introduce the abilities for the portfolios to short equities, right? With this instrument, with the SQQQ. So it shorts the NASDAQ market. So what does it mean to short? It basically is if the equity markets decline, and if you have exposure to this underlying instrument, that will rise in value. So it gives you the inverse effect. If the markets decline, this position increases. If the markets increase, and if you have exposure to this investment, then that is going to decrease. So you have a negative correlation to the markets, and that's what we want. We want to introduce investments that, again, they sort of perform in different, they demonstrate different behaviors and perform in different ways. So what is the AI solution doing? On a weekly basis, it's evaluating every single index, every single investment. It's going through 600 different ways of how to measure risk, and it comes up with a forecast for the following week, right? So it's not looking at what's going to happen in the next month, in the next quarter, or in the next year. That's way too far off. It's only looking at what's the most probable outcome for the next 7 days for each of these individual indices. And then the second part of it is, once you've come up with a forecast for the following week, then it looks at all of the indices and comes up with the best mix, with the best allocation, the best mix to invest into each of these indices, keeping in line with, the, let me go back here. Keep in line within these boundaries, right? So we have to keep within these boundaries. So we give the AI solution enough flexibility to identify what are the best investments for that following week. And again, we've sort of identified, we've expanded the investment universe to introduce things that are not correlated. So this just gives you an example from the investment outcome from 1 week to another. So what is this chart? So this chart is, we have all of the investment choices, all of the indices. And again, what are those indices? So we have exposures to short-term US Treasuries, long-term US Treasuries, investment grade bonds, high yield bonds, emerging market bonds. We have the S&P 500, which is US equity markets. We have the MSCI EFA, which are international large companies. And we have emerging markets companies as well. And then we have the new ones that I just mentioned is the consumer staples, which is the conservative equity allocation, gold, bonds, and the short instrument. So if we look at the allocations from 1 week to another, so when we incorporate this, so for the week of October 24th to the week of October 31st, you can see that, in terms of, this is the allocation for the AI balanced portfolio. We can see how it changed from 1 week to another. So it was allocated in the S&P 500 27%. The following week, it went to 0%, right? And you can see how it went to, as Alvin indicated, cash has been a strong performer. If you had cash in the portfolios, you were able to outperform because obviously both, the broader markets were down. So for this particular week, what's interesting that the portfolios went 53% in cash. And the S&P was down this week, was down 3% this week for the week. So we were able to dampen volatility for this particular week. And then it also had a very small position in this short position. So it went against the equity markets in short position. So when we look at the weekly performance, and again, we're just showing this as an example of the AI portfolios and how tactical they are, right? Very tactical, very few portfolios do you have that where the allocation changes from 1 week to another. You can see that when the equity markets were down, and they were down in this particular week, we managed to provide an upside or performance, a positive outcome. So the whole idea is provide positive outcomes for the markets. The following week, the markets rose on the week of November 7th, and you can see how the allocation changed. So the allocations changed where it increased exposure to this smaller company, the NASDAQ composite, right, went from 0 to 44%, and then it kept the cash position. And in this particular week, the performance was up 3% for the week. So in a down week, it managed to provide a positive performance, and in an up week, it participated. Again, I don't want to infer from just 2 or 3 weeks what is the trend for the longer term, but I'm just indicating in terms of what we're trying to do is with the introduction of these new investments, it is providing additional value that we didn't have before. So when we look at performance, and this is for very similarly for the AI growth portfolio, that in terms of what was at the end of the day, what was the final outcome? So the final outcome was a positive outcome, both when markets rose, when markets decline, and when the markets again recover. So I'm picking these 3 weeks because we had a lot of volatility as an example. And so when we look at performance, and this is at the end of November, so year to date, we still have unrealized losses, right, from this year, where again it's been a very difficult year. But when we start to see just the month of November, and just alluding to my previous slide, where if the investor misses out on when the market does recover, right, and it's specifically after these big corrections, then you miss out on this performance. So if we look at the performance for the AI portfolios for the month of November, the AI conservative was up to almost 2.5%. The AI balance was almost up 5%. The AI growth portfolio was almost, less than 6.85%, and the dynamic was up over 4%. So again, looking at, longer term view, it's been obviously a very difficult year. If we look back at, how we finished a year ago, 2021, and we had obviously very good performance on each of these portfolios, but not only 2021, but if we look at 2020 or even 2019, we've had pretty decent performance. So we had a very difficult year this year. But again, looking at short-term performance, looking at inflation, looking at interest rates, look at what Alvin indicated, we see some value in the market. And so, what we do as investors is try to take advantage when things appear cheap, when things are inexpensive, and we want to buy those things. And so, not to say that we're at the low point, but it looks like the markets are starting to recover. I went over my allotted time, and so apologies for that. Just wanted to cover that. So Those are my prepared remarks. And again, I want to thank everyone for participating in this call, and obviously your partnership. And if you have any questions, with Anne, and you could always reach out to us. And I wish everyone also a very festive season.
Thank you very much, Jorge. Thank you for your presentation. I do have one question for you. So that came through from one of the members of the audience. What percentage of the Sanlam investment in the AI portfolios are US based? The focus of both presentations seems mainly on the US market, and why is this?
Okay, I'll take that first thing. So the U.S. markets tend to lead the global markets, right? So we look at interest rate policy from the United States Federal Reserve policy, and the other 4 or 5 major central banks around the world sort of follow in line. So we've had inflation not only in the U.S., but we've had inflation, global inflation. So not only has the Federal Reserve increased interest rates, but also the Central Bank of Europe, the Bank of England, they've increased interest rates, not at the magnitude that the U.S. The Federal Reserve has increased rates. And the reason for that is that if you look at sort of economic growth in Europe, it's less than that of the United States because of, as Alvin alluded to, Europe is dealing with this conflict of the Ukraine and Russia, and that's spilling over into pan-European economies. And so we've had more uncertainty there. And so in terms of the AI portfolios, look, we do have exposure. We give it exposure to the global indices, the MSCI EFA, which is it represents global companies around the world. We also have emerging market exposure to that. So if sort of the AI solution identifies that is it's attractive from a valuation perspective for that given period, for that given week, it will allocate into that. It's just in this example, and the one that I showed, it hasn't allocated in those specific weeks. Has it invested in the past? Yes, it has invested in global companies or emerging market companies. So we do give exposure to allocate globally. The bias has been in the US because that's where it's looking for the best investment outcome. I don't know, Alvin, if you want to allude to, in terms of, just being, from a US-centric perspective.
Yes, thank you very much. Yeah, when you only have 15 minutes, you need to focus on something, and the US economy remains the biggest economy in the world. And it's also true, as Jorge said, that in the Western world, most of the economies are in sync at the moment, if you look at the economic cycle. And the US is leading the way. If you look at the global picture, though, the one economy that we didn't speak a lot about is the second biggest economy in the world, the Chinese economy. So the Chinese economy is not in sync with the rest of the world. And one of the reasons why they were not in sync is they applied this zero COVID policy. So when the economies in the rest of the world recovered after the initial period of COVID, the Chinese did not recover to the same extent. They are now in a position, by the way, where they've clearly indicated that they want to migrate from that zero COVID policy regime. The economy is likely to open up, and we would like to think that when the rest of the world is likely to slow down even further in terms of economic activity, that the Chinese economy can actually go the opposite direction by stimulating, because they don't have the same inflation problems, and by opening up the economy. So we are unlikely to see a recession in China, but in the rest of the world, things, the momentum is still, the tide is still going up in terms of economic momentum. But the reason, quite frankly, is just, if you look at global equities, the basket of global equities, the US equities constitute about 72% of the MSCI World Index. So it is the biggest component, and therefore, in sessions like this, you tend to focus on the biggest component.
Thank you, Jorge. Thank you, Alain, for those explanations. I do have a few more questions, but I believe we're already out of time. So apologies if I haven't been able to ask your question live, but I will get back to you by email and also ask the question to Jorge and Alain for their comments as well when getting back to you. On behalf of everyone here at Sanlam Private Wealth, thank you very much to Jorge and Alain for your time and for the presentation, and for all members that were able to join us today. Thank you again for your trust in Sanlam and in us. As always, I'm always available for any questions or queries. If you need me, you know where to reach me. And I wish you all a very happy end of year and end of 2022, which has been a very tough year for everyone. So hopefully next year will be brighter for our portfolios and for the markets and for everyone. Thank you very much, everyone, and let's talk again in the new year for our session, which will hopefully be in Q1 of next year.